So, when you look at a company's financial report, you see all these numbers, right? Revenue, profit, assets. But have you ever really stopped to think about what's actually holding those numbers together? Turns out, underneath every single one of those figures is this complex, kind of invisible system of rules and principles. It's the only reason we can trust what we see. So, what are these unwritten rules? I mean, that's the big question, isn't it? Could a company just decide, hey, our headquarters is worth $1 trillion just because they feel like it? Or say that all the money they spend on coffee is actually a long-term investment? Well, the short answer is a big, fat no. And the reason why is what basically holds our entire financial system together.
Just imagine trying to have a conversation where everybody's speaking a totally different language. It would be absolute chaos. And that's exactly what the financial world would be like without a shared set of rules. How on earth could you compare a giant like Apple with your local coffee shop? You couldn't. Investor trust would just poof, evaporate, and the global markets would grind to a halt.
So in this explainer, we're going to pull back the curtain on that hidden rulebook. We'll start with why we even need a common language. Then we'll get into the Constitution that guides it all. We'll break down what makes financial info actually useful, figure out who writes these rules, and wrap up with a pretty cool debate on the philosophy behind it all.
Okay, first things first. Let's really nail down the fundamental need for these frameworks. It's all about creating a level playing field, making sure everyone is speaking the same financial language.
You see, the whole point of financial reporting isn't just to track numbers for the fun of it. The main goal, the big objective, is to give people information that is useful. Useful for whom, you ask? Well, for investors trying to decide if they should buy some stock, for banks thinking about giving out a loan, and for suppliers who need to know if they're going to get paid. At the end of the day, it's about giving people the tools they need to make smart economic decisions.
All right, so if financial reporting is a language, then every language needs grammar, right? A set of core principles that govern everything. This is where we bring in something called the conceptual framework. And honestly, the best way to think of it is as the Constitution for accounting.
Now, the key thing to get here is that the conceptual framework isn't a specific rule for a specific situation. It's not going to tell you exactly how to account for a coffee machine. Instead, it's the high-level philosophy, the big ideas. It's the North Star that makes sure that when new, detailed rules are created, they're all consistent and make sense together, instead of just being a random patchwork of regulations. And a huge part of this Constitution is the idea of recognition. You can think of it like a bouncer at the velvet rope of the financial statements. Not everything just gets to walk in. An item, whether it's an asset you own or a debt you owe, only gets recognized or officially put on the books if it meets some really specific criteria. Basically, is it relevant and can we measure it reliably? If not, it's not getting in.
So we keep using that word useful. But what does useful actually mean when we're talking about financial data? Well, the framework gets super specific and breaks it down into a few key qualities that all trustworthy information should have.
Think of these as the ultimate quality control checklist. First, info has to be relevant, meaning it could actually make a difference in a decision you're about to make. It also has to be a faithful representation of what actually happened. It needs to be complete, neutral, and not full of mistakes. And then you've got these other boosters. Is it understandable to someone who knows a bit about business? Could different smart people look at it and agree on what it means? That's verifiability. And is it timely? Because let's be real, last year's news isn't very helpful for making decisions today. Okay, so we've got our Constitution, the conceptual framework. But who takes that high-level philosophy and turns it into the actual detailed laws that companies have to follow every single day? Well, that's the job of the regulatory framework.
For a huge part of the world, the answer is the International Accounting Standards Board, or ISB for short. This is an independent group, and they're the ones who develop and publish the official rulebook, which is known as the International Financial Reporting Standards, or IFRS. You can pretty much think of them as the global parliament of the accounting world.
And these rules don't just appear out of thin air in some back room. There's a whole formal public process. It all starts when a problem is identified. Maybe there's a new kind of business transaction that the old rules don't cover. The board then does a ton of research, puts out papers for public comment, releases a draft of the new rule for even more feedback, and only after all that does a final standard get issued.
And this brings us to our final section, and honestly, a really interesting debate that sits right at the heart of accounting. How should you even write these rules? Should you create broad principles that require people to use their judgment, or should you write super detailed, strict rules for every possible thing that could ever happen?
So you've got two main philosophies here. On one side, you have a principles-based approach, which is what IFRS is all about. This gives you a broad framework and trusts accountants to use their professional judgment to follow the spirit of the rule. On the other side, you have a rules-based system, which tries to write a specific instruction for every scenario. Now that might sound easier, but it can actually lead to this endless game of cat and mouse where companies find clever loopholes that technically follow the letter of the law, but completely miss the point.
In this quote, it just nails the whole idea behind the principles-based system. The focus is on achieving the real objective, like showing an honest picture of what happened, rather than just blindly ticking a box on some narrow rule. It's all about substance over form.
So why does any of this matter right now? Well, here's the kicker. This same rigorous, thoughtful approach is now being expanded beyond just dollars and cents. The IFRS Foundation has set up a new board, the ISSB, and their job is to create global standards for reporting on sustainability and climate information. This is a massive step toward making that kind of data just as reliable and comparable as the financial numbers we're all used to.
So, look, if you take away just one thing from all of this, let it be this. These frameworks, they aren't just some boring accounting theory for textbooks. They are the absolute bedrock of trust. They're what holds up our entire global financial system. It's what allows money to move, businesses to get funding, and economies to actually work. Without them, it's chaos. And that leaves us with a final, really big thought. We've seen how the language of money has evolved over decades to build trust. But now, as we're facing these huge new challenges, from the complexities of AI to the absolute urgency of climate change, how does this language need to adapt again to stay useful and to stay trustworthy? That's the billion-dollar question that the rulemakers are tackling right now.